Hello, 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 ambitious business owners. Welcome back. Happy Monday. Today, we're going to be turning traditional business accounting on its head with Profit First Method. If you're always wondering where your profits went at the end of the month, at the end of the week, at the end of the quarter, or at the end of the year, this approach might just be the game changer that you will need. We're going to get into talking about Profit First financial health for your business. But before we get into this sweet little topic, let me introduce myself. So, my name is Shane Harris, and around here on these social media corners, I'm also referred to as Shane the Negotiator. And I help coaches, consultants, and service providers who are overwhelmed and lack guidance to achieve true financial freedom. And I do that by providing expert tax and coaching services. That is what I do. That is who I help. So let's get on into understanding profit first. So typically, business operate on a formula which is sales minus expenses equals profits. That's the traditional sense. However, the profit first method flips it around and it goes like this: sales minus profit equals expenses. This means you allocate the profits for each sales first, and then you use whatever is left for expenses. It's a mindset shift that prioritizes financial health and profitability from day one. So this is the sweet way on how to scale your business the new way versus the old school way of doing things. So I'm going to break this down for you. So implementing profit first in your business. So to get started, we're going to begin with opening multiple bank accounts for different purposes. So one account will be for profits because we like to get profits, one for owner's compensation to pay yourself, one for taxes. You know we have to pay our taxes, right? And one for operating expenses. That's for all other operations in your business. Every time revenue or your income come into the account, you allocate a percentage to each one of those accounts based on a predetermined number. This way, you ensure your profits is not an afterthought, but it's a priority. So the old way, you took profits on the end. Sometimes you didn't have profits to take. Well, this is the way we flip it around, and you're withholding your profits first, and then you spend on everything else so that you can have money in your business and for it to be sustainable. So real life applications. Let's get into an example. Let's say you're a consultant earning $10,000 a month. According to your profit first plan, you allocate 15% to your profits, 50%, 50, to your owner's pay to pay yourself, 15% to taxes, got to pay uncle, right? And 20% to your expenses. That's your operational expenses. That means $1,500 goes directly to your profits account, making sure you can see the fruits of your labor immediately, today, not tomorrow, not next week, not at the end of the year, today. So let's talk about the benefits of the profit first method. So this system forces you to work with what's left for expenses, encouraging you in innovation and cost cutting. So it helps you to budget better. It helps build a financial cushion, ensuring that you have funds set aside for taxes and, of course, for profits, reducing financial stress and uncertainty. So challenges and how to overcome them. The biggest challenge is going to be in discipline. It can be very tempting to dip into the profits or the tax account when your expenses exceed their allocated budget. So when you're over budget and you're looking at that profit and you're looking at that tax account and you're like, let me just go ahead and borrow over there. No, you are stealing from yourself. To succeed, you must be steadfast in adhering to your allocations and continuously evaluate and adjust them as your business grows and evolves. So customizing the profit first for your business. Every business is unique, so your allocations might differ from the standard. So you start with the recommended allocations, but adjust them based on your business needs and goals. It's all about finding the right balance for sustainable growth. So let me show you an example on what this looked like. I'm gonna have some examples for you guys. So I have another chart that I have created. Well, this is some clients of mine that I've compiled their data and I popped it on this chart. So this is two different clients that I have put together to create this chart. So these are real numbers, but the name of the client is going to be different. So it's two different businesses I lumped into one with real numbers and real types of businesses. So this is our social media client LLC. So this is the Profit First Taxes sheet. And if you would like a copy of this sheet, you reach out to me and I'll be happy to get one to you because it makes it a little bit easier for you. So I customize this particular sheet at Profit First Taxes for the different types of clientele that I have, and you can do something similar for yourself. So I tend to work with service-based businesses, but I also work with product-based businesses. So I have e-commerce clients and I have service-based clients as well. So I have coaches, I have consultants, and I have other types of service-based businesses. And of course, I have e-commerce and some coaching businesses. They also sell products. So in this example one, the first client that I've lumped in here is an e-commerce client. And if you look at where it says it starts in May. So for this particular scenario, I copied it from 2021 and one of the clients came in May. So when they came in the month of May, we started at May. So whatever month they came into the business, that is the month we began working on this sheet. So I just copied this sheet. I add the two clients on here and we continued on. Otherwise, it generally, starts with January and it goes down through the rest of the year. So with the Profit First method of accounting, you allocate certain percentages and it's predetermined. So if you read the book, Profit First by Mike Malkowicz, he has standard percentages for business owners based on the revenue. That particular model, it's a start. However, Profit First Taxes over here where Shane the negotiator reside, I have customated, sorry, my English is terrible. I have custom made my sheet to reflect based on the type of business that you have. So for this e-commerce business, we started out with these percentages, but this was not the goal. The goal was to get them to a different percentage type. But when you're first getting started, you can't always jump into the recommended percentages because you have to work your way up. So each quarter, we reevaluate, we make adjustments, and we change the percentages until we get to the goal percentages that is set for this particular client. So for this particular client, which is an e-commerce client, when they got started, this company started with 5% going towards their profits. The owner's pay or the owner's draw to pay themselves was 22%. Taxes started at 5%. Operating expenses started at 28%. And we had an inventory account started at 40%. So a different client, like if, we're going to go down and look at my second client, who is a service-based client, that client does not have an inventory account. So we create an inventory account because the purpose is so that the client can have funds to re-up the inventory supplies and not have it mixed with the operating expense account. Because in order for this client to continue to run her business and be sustainable and be profitable, she has to have money to keep repurchasing the inventory so that she can sell. So if there's no money to purchase inventory, the client's not going to make any money. So I've created a separate account category for my e-commerce client, which is the inventory account, so that they can house funds in there at a predetermined percentage. And then it's pretty much split between the inventory and the operating expense. And I put a percentage for the operating expense and the rest into inventory. So this is the percentages the client started out at. And of course, we end up increasing as we went along, which is not on this sheet. So to get started, the client came in. So we do the allocations twice a month, on the 10th of the month and on the 25th of the month. So as you can see, every single month, you see the 10th is on the left, the 25th is on the right. So the 10th of the month is all of the transactions that came in from the 25th of the previous month to the 9th of the current month. And then the next day, we do the budget, calculate how much the client has made. Based on the percentages, we place the percentages into the allocation slot. That is going to be the budget. And then what's under the deposit column on the far right, it says deposit. That is the total amount that is deposited into each one of those designated accounts. So we name the account exactly what the percentages say. So in the client's bank account, it's going to say, one bank account is going to say profits. One's going to say owner's pay or OPAY. Another one is going to say tax or taxes. The next one is going to say operating expense or OPEX, OPEX. And then, of course, we're going to have inventory. So as you can see on the right side, it says account name. That is how we labeled the accounts in the client's bank. So whenever the month comes, the 10th comes, I go in there, or my team go in there, and they go and they look at the profit and loss sheet, and they calculate, they see what the percentage is, what the income the client had, the revenue, the sales that came in between the 25th and the 9th of the month. And on 25th, they put that total online where it says income. So this particular client in May of whatever year this was, it's for our social media client, is $8,025 they made in that 2-week period. So these are the percentages. So 5% for profits is 401. Owners pay 22% is 1799. 5% for taxes is 401. Operating expenses at 28% is 2247. Inventory at 40% is 3210 for a total of 8,025. So we're going to go over to the next half of the month. So the next 2 weeks went along. So you're going to take everything from the 10th of the month to the 24th of the following month. And then the next day on the 25th, you rinse and repeat. You go back in and you pull up that profit and loss sheet. After you have done all your categorizations of your income, you pull up all your income that came in that 2-week period, and you put the total in the income column. So for the 25th of this month, for May, for that particular year, for Social Media Client LLC, the income is $15,355. So we allocated the percentages on the allocations, and then the deposit side has the total amount, and they deposit it to these accounts that's on the right. So what I do, I take a screenshot of the box that we're in. So let's say we're in May. I will take a screenshot of the entire May's box, and I email it to the client with a note saying, hey, here is the budget for the last 2 weeks, and any recommendations that I may have in terms of are they on budget, are they over budget, whatever the situation is based on what's in the books. Where it has spent, now you are not necessarily, you don't need to use the spent, but I have this spent column when clients usually get started with me, and sometimes we have numbers in the spent column. This spent column is when we're transitioning our clients. Sometimes they're still using funds in the wrong account. So they still have these bank accounts. They may have direct deposits, or not direct deposit, ACH payments coming out of the owner's pay account, or they may have expenses coming out of the inventory account, but it belongs underneath the operating expense account. So until we get everybody or you yourself get on a smooth track or transition where everything is coming out and going out from the appropriate account, that spent account is there to make corrections. So let's say, for instance, this particular client paid an employee wages. So the money was supposed to come out of the operating expense account, but it's on automatic because they just started implementing this and they forgot that when they pay this particular employee, it's on auto pay and it comes out of this inventory account. So let's say they paid that person $3,000. In this spent column underneath inventory, I would put negative $3,000. So that would subtract from the 3210 that was supposed to be given to this client for as a budget, and then only $210 would be deposited into their account. So I hope that makes sense. So that was a little piece I added in to explain this particular chart, just in case you guys end up wanting this chart. It's going to be for you want this chart, then you can go ahead. You have an idea of how to utilize it. So that's pretty much that. So for May, we had the 10th and the 25th. These were the allocations. For June, the 10th was 73.31. The 25th was 27.36, and those allocations was given to the clients. So let's move on to our second client. This is a service-based client. This was actually a coaching client. So this client have a coaching business. So the income that this client made in July was $30,593 for the 10th of the month. So the 25th of June to the 9th of July, this was the total amount that the client made. And on the 10th of the month, we went in there, we did the report, we ran the profit and loss, we put the 30,593, and then the allocated percentages that were designated to this particular client. So as you can see, this client is not an product-based client, it's a service-based client. The percentages look differently. So this particular client started out pretty much close to the recommended, which was pretty much the recommended percentage rate, close to the percentage rate that we would like for a service-based client. So for profits, it's 5%, which matches our e-commerce client. Owner's pay is at 25%, which is slightly higher from our e-commerce client. Taxes is at 15%, which is definitely the recommended amount that we do take out for taxes. Of course, we go up as you go up in income and you start to get those higher thresholds, we go up to 20% and so forth. The operating expense is 45% and then 10% for savings versus the e-commerce client that had the inventory and the operating expense. So my e-commerce client had a bigger percentage going to the operating expense and inventory collectively, whereas this one only have the operating expense at 45%, and then we added in a savings account. Eventually, we did add in a savings account for the inventory for the e-commerce client. We added in a sixth account and we named that savings, but we had to work with the client to get to those ideal percentages so that we can do so. So it's a process. You don't just wake up one day and say, I want these percentages, and you start doing that, because what will happen is you're going to start robbing yourself. You're going to start stealing from yourself because you're not going to have enough money in your operating expense account to cover your expenses. So you're going to be pulling it from those other accounts. So that's why we start off with lower percentages and slowly work your way up. So if you add a percentage somewhere, you have to take a percentage from someplace else. So for instance, let's say we wanted to get our e-commerce client up to 15% from this 5%. So we have to add 10% to that. So therefore, we have to take 10% from someplace else, because everything has to add up to 100%. So we might take 10% from the inventory, which leaves at 30%, and add that 10% to the taxes, which makes it 15%. So we do play around with the numbers quite often. This is why it's very important to have an accountant or bookkeeper on your team so that you can work with them to optimize your profits in your business. And especially if you're using this profit first method of accounting, work with someone who is familiar with it so that you can get the most out of your business. So let's go through what these numbers look like. So for our coaching client that made the 30,593 on the 10th, 1,530 went to profits, which is 5%. The owner's pay was 25%, so that was $7,648. Fat taxes was 15%, so that's $45.89. And then we have the operating expense at 45%, which is $13,767. And then lastly, we had 10% that went towards savings, $3,059 that went to savings. When I copied this, I didn't correct where it says, I went down to the next page, where it says inventory on the names of the accounts paid. It should have said savings there. But when I copied things over, I didn't copy it correctly. So I missed the savings there. So if you're looking back in this and you say, well, it doesn't match up, it's supposed to say savings. I just didn't change it. So that's pretty much that. So this particular client had $30,593 the 10th. On the 25th, they had $70,488. And as the months went on, they increased more. And then, so forth. So that's pretty much the example that I wanted to share with you on what it looks like when it's on paper and what it'll look like in your bank account. So I have clients where I send them a screenshot. So with this particular client, I would take a screenshot of July 10th or the 25th, depending on which month we were in and the date. And I would send them an email, or my team would send an email and say, here is the budget for the last 2 weeks and whatever notes that we have for this particular client for the 2-week period. So once this is done, there's a nice little incentive that we do every single quarter. So every quarter, these profits accounts is going to be accumulating. So we're going to calculate. So this is July, August, and we're going to make up a number for September. So for this particular consulting coaching client, the profits was $1,530 for the 10th of July. Then it was for the 25th of July, $35.24. Then we go to the 10th of August. It was $11.95. And then we're going to go to the 25th of August, which is $26.01. So that's $8,850. So I'm just going to multiply that by 2, just so I can pretend we had numbers for September, because these numbers I didn't fill in September. This was an old sheet I took from another client. So let's say it was $17,700 at the end of the quarter for this particular client who was a consultant client, or a coach client that has a coaching and consulting business. So the $17,700 in the profits account, guess what you get to do with it? And this is a nice little incentive my clients enjoy, because they get to reward themselves every single quarter. This $17,700 that they would have accumulated over that 3-month period, divide that by 2, and it's $8,850. And guess what they get to do with that $8,850 whole dollars? You might not have guessed, right? They get to take that and do whatever the heck they want with it personally. It does not go to any of the business accounts. It does not go to paying any business expense, paying any business bills, paying any contractors. It is nothing to do with the business. They get to transfer this money from their business to their personal bank account and do with it whatever they want to. They can pay some personal bills. They can take a vacation. They can give the money to the kids. They can donate to charity. They can do whatever they want with it. So this is a nice little incentive that I use. And it's not just I use it. It was created in the Profit First method that Mike Malkovich wrote in his book. And I continue this system because it works. I use the system for all of my businesses. I use this system for all of my monthly clients. And I've also taught this class to multiple people that have used the system as well in their business. So $8,850. Now, I don't know about you, but I can use $8,850 to go on a vacation or do whatever the heck I want with it. This is the incentive to stay on budget. So you do not want to run out of funds and go pull from your profits account, because it's going to cut into your profits at the end of the quarter for you to go and do whatever you want with it. So by continuing this method here, the client continues, and yourself, you continue to build your profits account. You get to reward yourself every quarter. And it also, you're like, you know what? I only had 8,000. I'm going to try to increase my sales, get new clients in, get new customers in, put new products and services out there so I can make more money. The more money you make, the more you can put into that profits account. The tax account is exactly what it says, is to pay the taxes. So every quarter, my clients and yourself, you will not have to worry about, oh my gosh, I don't have it to pay the taxes. How am I pay my taxes? Now you don't have no excuse not to pay your estimated tax payments because you have an account that's going to be holding your taxes for you. So all you have to do is calculate up what your estimated tax will be for that quarter, look in your account and send the payment to the IRS, and the money keeps coming in every 2 weeks to replenish that account. Your operating expense account, that is going to go from paying your employees, paying your contractors, paying the rent if you have rent, paying whatever utilities, paying all the expenses that is in your business. That operating expense account is going to, that is what the operating expense account is going to be for. In the savings account, once you get to that point where you can start utilizing a savings account, because many people that start working with me in Profit First Taxes, they don't initially start off with a savings account. We have to work our way up to a savings account. First, we get to those closer to those ideal percentages, and then we start adding in the savings once you start having the excess funds to do so. Now, that savings account is your emergency fund for your business. And once you work with me over here at Profit First Taxes, I'll teach you what you start to utilize, what you use that savings account for. And one of the tips that I can give you is we use that savings account to start putting money into your retirement account. So that's a part of tax planning that we do. So you can take some of what's in the savings account, and once you set up your retirement account, as we talked about retirement accounts on the last video, and I would have that link somewhere up here for you so that you can go back and watch that video on retirement account. You can put the monies is coming from your savings account, so you don't have to worry about overspending in your accounts and not having enough money to put into your retirement account. So I hope I explained this to you guys for you to understand. And again, if you want my template, I'll give that to you. You just reach out to me and let me know. You can send me an email and you can get the copy of this for yourself and utilize it in your business. So let's get back into the other, did I leave it? Okay, yes, let's get back into the other slide now. All right, let me get my screen back. You know, I'll be slow sometimes, slow on the draw. Okay, so let's get on back. So some key takeaways from this. So the Profit First isn't just about accounting. It's a tool for making strategic business decisions. By prioritizing your profits, you ensure that your business is financially viable and healthy in the long run. So to wrap this all up, that's our look into the Profit First method. By rethinking the way you handle your finances, you can build a more profitable and sustainable business. This is a great way to budget in your business. I know a lot of times you guys don't want to hear about budgeting or you're not quite sure how to do it. This is the perfect example on how you can start implementing this in your business to start to budget correctly. So if you are starting to, there's such thing as being over budget, because you can start getting too much money into your profits account. Like say some clients want to have 10% go into their profits account. I don't recommend starting off at 10%. 5% is more ideal. However, if you're in the revenue point of 500K or more and you're paying yourself the appropriate amount that you need to pay yourself based on the industry standard, and you have excess monies, your budget is pretty tight, so your expense account have a good amount of monies going in there, and you do have this excess, your savings account is where the rest of the money may need to go to. And as I said, if you're maxed out at what you want to pay yourself, if you're not paying yourself enough, well, if you have excess money going to your savings account, well, then you can reduce the percentage from if you have excess money going into your operating expense account, you can reduce the percentage that's going there and put it into paying yourself or put it into savings. So you can fluctuate, play around as however ways that you like it. Another thing I said, I do a screenshot of the let me add it back to the stage so that you can see it. As I said, I do a screenshot of the box, whichever 2-week period that we're in, and I email it to my client. The other option for some of my clients who just don't have the time, I actually do the transfers for them. So me, Shane Harris, I personally do the transfers. I do not let any of my team members do the transfers because I'm directly going into your bank account and transferring these monies into your multiple different accounts. So I do that myself. I have not had any of my team members do it. Now they can do the budget, but I do not let them do the actual transfers. So there's some clients who don't have time for it. I do the actual transfers to the multiple accounts, and then they still get the screenshot of that box. I send it to them in an email and I say, here is your budget for the last 2 weeks. These are the percentages here. I have deposited the appropriate amounts into your bank accounts. I've paid whatever credit card bills that needs to get paid, whatever for the business. When it's time to transfer the monies to the profit, I don't transfer the money to the profit's account. I have my clients do that because I want you guys to actually go in there and be able to see and transfer that amount yourself so that you can see how much you have saved and how much your hard work by staying on budget is rewarding you. So I actually let you transfer those yourself. And for everybody else that's doing the transfers themselves on all the accounts, they just get the information and they go ahead and follow the sheet and transfer those amounts into their accounts. Okay, so I explained this and it makes sense for you all. So let's get into some teasers for next week. So in our next session, we'll uncover the essentials of financial statements. Now, the financial statements is going to be needed. Understanding these is crucial for any business owners. So join me for Decipher Financial Statements, your business report card to gain valuable insights into your business and financial health. Now, these financial statements is going to be key. So I don't know if you remember me. If you have not heard me talk about the previously, go back and watch some of the previous videos. But I have spoken on the previous videos about financial statements. This is what you're going to need to file your taxes. So that's why it's very important to have bookkeeping, to have done bookkeeping or some type of accounting so that you can have these financial statements. The financial statements is what's needed to put together these reports so that we can actually put together that budget sheet that we had up on the screen there. So financial statements is going to be very important. And when I come back on Friday, I'm going to be going through what financial statements are, how to decipher them, and what is the difference between them. Okay, so in closing, thank you for tuning in. If you're finding these sessions helpful, don't forget to like, share, subscribe, tell a friend. Here's to your continuing success and prosperity, and I'll see you on the next video. Have a great day.